There is something happening inside the global financial system right now that almost nobody is talking about correctly. Most people think financial change arrives with dramatic headlines, market crash, emergency meetings, and television anchors shouting about panic. History tells a different story. The biggest financial shifts usually begin quietly. They begin while stock markets are still functioning, while people are still going to work, while retirement accounts still look healthy, and while the average person assumes tomorrow will look very similar to today. That is exactly why I want your attention for the next few minutes, because the evidence I have been studying points toward a long-term transformation that could affect the value of your savings, your investments, and your future purchasing power. For decades, the United States has enjoyed a unique position in the global economy. The U.S. dollar became the world's dominant reserve currency. Governments held it, banks relied on it, international trade used it, energy transactions were often priced in it. This created enormous demand for dollars across the world. As long as that demand remained strong, America benefited from extraordinary financial advantages. But throughout history, every dominant system eventually faces competition, not necessarily because it fails, but because the world changes. New economic powers emerge, new alliances form, new technologies create alternative systems. The question investors should be asking is not whether change is possible. The question is whether change is already underway. Several months ago, I began examining conversations taking place among global investors, central banks, sovereign wealth funds, and major financial institutions. What caught my attention was not a prediction of collapse. In fact, very few serious investors were talking about collapse at all. Instead, they were talking about diversification. That word appeared again and again. Diversification of reserves, diversification of trade relationships, diversification of investment exposure, diversification away from dependence on any single country, currency, or system. At first glance, that might not sound important, but when enough participants begin making similar decisions, the effects become significant. Imagine a giant river slowly changing direction. On any single day, the movement appears insignificant, but over time, the entire landscape changes. Global capital works the same way. Small decisions repeated by thousands of institutions can eventually reshape markets, valuations, and economic power. One experienced investor explained it to me in a way I will never forget. He said, "The greatest financial opportunities and risks are usually visible years before the public notices them. The reason is simple. Most people focus on headlines. Professionals focus on flows. Headlines tell you what happened yesterday. Capital flows tell you what may happen tomorrow." When I started looking at those flows, several trends became impossible to ignore. Central banks around the world have been increasing purchases of gold. International trade agreements are increasingly being settled in multiple currencies. Governments are exploring alternative payment systems. Large institutions are expanding their investment exposure beyond traditional concentrations. None of these developments individually guarantees a major shift, but together they suggest something important. The world is becoming financially more diversified. History provides valuable lessons here. Every major economic transition has rewarded people who prepared early rather than reacted late. During the rise of the United States in the 20th century, investors who recognized changing economic leadership benefited enormously. During the growth of Asian economies, investors who understood long-term trends gained opportunities others missed. The pattern repeats again and again. Major shifts are usually gradual before they become obvious. One of the biggest mistakes investors make is assuming that recent performance predicts future performance. Human beings naturally project the present into the future. If a market has performed well for 10 years, people assume it will continue performing well indefinitely. If an asset has struggled, they assume it will always struggle. Yet history repeatedly demonstrates that leadership rotates, markets evolve, valuations matter, conditions change. This is particularly important when discussing risk. Most people think risk means volatility. They think risk means watching prices move up and down. But true risk is often much quieter. True risk is losing purchasing power over long periods of time. True risk is believing your money is growing when inflation is quietly reducing what that money can actually buy. True risk is concentration, when too much wealth depends on a single outcome, a single country, a single currency, or a single asset class. Vulnerability increases. That realization caused me to rethink the way many investors approach portfolio construction. Instead of asking, what will perform best, a more useful question may be, what can survive multiple futures? Nobody knows exactly what the next decade will bring. Interest rates could rise or fall. Technology could accelerate productivity. Geopolitical relationships could strengthen or weaken. Economic leadership could shift. Because uncertainty is unavoidable, resilience becomes incredibly valuable. Resilience is a concept that sophisticated investors understand deeply. They do not build portfolios based on perfect predictions. They build portfolios based on probabilities. They recognize that being completely right is unnecessary. What matters is remaining financially strong across a range of possible outcomes. That mindset often leads to broader diversification, greater flexibility, and a stronger focus on preserving purchasing power. One asset frequently discussed in this context is gold. Gold has existed as a store of value for thousands of years. Unlike businesses, it does not generate earnings. Unlike bonds, it does not pay interest. Yet gold has one characteristic that explains why institutions continue holding it. It exists outside many traditional financial structures. For that reason, central banks often view it as a strategic reserve asset. Whether someone personally likes gold or not is less important than understanding why major institutions continue accumulating it. Another area attracting attention is international investing. For years, many investors concentrated heavily in domestic markets because those markets produced strong returns. There is nothing inherently wrong with that. However, when valuation differences become historically large, experienced investors begin paying attention. Lower valuations do not guarantee superior future returns, but they often create opportunities worth studying. This is one reason why many global institutions continue expanding international exposure despite uncertainty. As I continued researching these trends, one conclusion became increasingly clear. The next decade may not resemble the previous decade. That does not mean catastrophe. It does not mean collapse. It simply means change. Different sectors may lead. Different regions may outperform. Different strategies may become more effective. Investors who remain open-minded will likely adapt more successfully than those who assume the future must mirror the past. Think about how rapidly the world has changed over the last 20 years. Technologies that barely existed now dominate industries. Entire business models have emerged and transformed daily life. Economic relationships between countries have evolved dramatically. If so much can change in 20 years, it would be unreasonable to assume the next 20 years will remain static. The challenge for investors is psychological. People become attached to familiar narratives. Familiar narratives create comfort. Comfort creates complacency. Complacency often leads to poor preparation. The most successful long-term investors avoid this trap. They constantly reevaluate assumptions. They ask difficult questions. They challenge their own beliefs. Most importantly, they remain willing to adapt when evidence changes. That may be the most important lesson of all. Financial success is not about predicting the future with perfect accuracy. Nobody can do that consistently. Financial success is about responding intelligently to changing information. It is about understanding cycles, respecting uncertainty, and maintaining enough flexibility to benefit from opportunities. while protecting against risks. As we move through the coming years, there will be countless predictions. Some people will forecast endless prosperity. Others will forecast disaster. Most of those predictions will be wrong in one way or another. Reality is usually more complicated than either extreme. What matters is not choosing a side in a debate. What matters is preparing for a range of possibilities. The investors who thrive through major transitions are rarely the loudest voices. They are usually the most disciplined. They focus on diversification. They focus on resilience. They focus on preserving purchasing power. They understand that wealth is built not only through growth, but through survival. The world economy is evolving. Capital is moving. Institutions are adapting. New opportunities are emerging while old assumptions are being questioned. Whether these trends accelerate or slow down, one thing is certain: change is a permanent feature of financial history. The individuals who recognize that reality early place themselves in a stronger position than those who ignore it. So the question is not whether the future will be different. The future is always different. The real question is whether your financial strategy is prepared for that difference, because history shows that the greatest opportunities often belong to those who see change before it becomes obvious to everyone else. If you found this discussion valuable, continue learning, continue questioning assumptions, and continue studying the forces shaping the global economy. The people who remain informed today are often the people best prepared for tomorrow.